Welcome to The Explainer. Today, we're going to trace the ripple effect of a conflict in the Middle East and follow it all the way back to your wallet. We're digging into how military actions in the Red Sea are directly hitting the prices you pay for, well, pretty much everything.
Okay, so here's how we're going to break it all down. First, we'll look at the military spark that really lit this fire. Then we'll see exactly how that puts our energy supplies at risk and starts driving up prices, especially in Europe. We'll also dive into how governments and investors are trying to react, and finally, what this all means for what looks like a new, much more unpredictable world.
All right, let's get into it. We are way past the point of strongly worded letters and diplomatic talks. The situation in the Middle East has now blown up into major military action. And believe me, the shockwaves are already being felt thousands of miles away.
Yeah, this conflict is definitely not contained anymore. You've got a U.S. Marine unit on the ground, and we're seeing attacks on critical industrial sites in the UAE and Bahrain. But the real game changer here is the entry of Houthi militants, who are now directly targeting Israel. This signals a whole new and, frankly, a much more dangerous phase of this war.
So all this military action has a direct and immediate economic consequence. It's a huge threat to global energy supplies. And as you're about to see, what was already one big vulnerability has suddenly become two.
So get this, even before this latest mess kicked off, the global market was already in a really tight spot. Disruptions around the Strait of Hormuz had basically taken a staggering 9 million barrels of oil per day off the market. That is a massive hole in global supply that was already pushing prices up.
Right, so that was the existing problem. But now the conflict has opened up a whole second front for energy markets, creating a brand new and incredibly concentrated point of failure.
So here's the crucial point. To get around that first choke point, Saudi Arabia cleverly rerouted a huge amount of its oil, we're talking 5 million barrels a day, through the Red Sea. This became a vital lifeline for global markets. But now, with Houthi militants in the fight, that lifeline is under direct threat. So we now have two of the world's most critical energy arteries at risk at the exact same time.
Okay, this isn't just some abstract problem for oil traders on Wall Street. The supply disruption is translating directly into higher prices for you and me, with the impact hitting Europe's industrial core, Germany specifically, really, really hard.
And look, the impact is immediate, and it's crystal clear. In just 1 month, key industrial regions in Germany saw inflation jump by over 1%. Now, this isn't a slow creep. It's a sudden jolt to Europe's biggest economy, and it's caused directly by that energy shock we were just talking about.
Now this is where it gets really interesting. Check out this take from BlackRock. That comfortable period of falling inflation that everybody, especially the central bankers, was starting to enjoy, well, it's now in serious jeopardy. This supply shock is threatening to undo all of that progress.
This creates an almost impossible choice for central banks. It's a real catch-22. If they raise interest rates to fight inflation, they risk tanking an already slowing economy. But if they don't, they risk letting prices spiral completely out of control. This is the classic nightmare scenario: high inflation and stagnant growth. And honestly, there are no easy answers.
So with inflation making a comeback and economic growth at risk, governments and investors are basically being forced to tear up their playbooks and rethink their strategies in real time. Policymakers, like Portugal's finance minister, are making a really important distinction between now and what happened back in 2022. Remember then? We had a dual shock. Supply chains were broken, and consumer demand was going through the roof. Today, the problem is more focused. It's an energy supply shock that's hitting an economy that's already been cooled off by some pretty aggressive rate hikes.
So, how are governments handling this? Well, some countries with healthier finances, like Portugal, are actually using their budget surpluses to soften the blow. And they're not just throwing money around. They're offering targeted relief, things like fuel discounts for families and trucking companies, all while trying to keep their national debt under control.
Meanwhile, the smart money is looking right past the day-to-day market chaos. Investors are focusing on the big, long-term trends that this conflict is speeding up, and they are moving their capital accordingly.
These 4 areas are where investors are seeing huge long-term opportunities. This crisis has shown everyone that relying on fragile, far-flung supply chains is a massive vulnerability. So securing energy independence, bringing manufacturing back home, upgrading infrastructure for this new reality, and of course, boosting defense spending, these are now seen as critical national security priorities. This represents a gigantic shift in capital, creating what a lot of people think will be the defining growth stories for the next decade.
So if there's one thing you should take away from all of this, it's that this isn't just another short-term crisis that's going to fade away. It represents a fundamental and maybe even a permanent shift in how we all have to think about geopolitical risk.
According to top analysts like Sanam Vakil at Chatham House, the conflict hasn't actually weakened the Iranian regime. It's done the opposite. It's created a more hardened, militaristic state. What that means is we really shouldn't expect a quick and easy resolution. We should probably buckle up for a long period of instability and confrontation in the region.
And that leaves us with one final and pretty crucial question. This crisis has exposed some deep vulnerabilities in our just-in-time supply chains and our fragile energy markets. It really forces us to ask, in a world where these kinds of shocks are becoming more frequent and more connected, how prepared are we really for that inevitable next ripple?